Hey everybody, Mitch Wilder here with the Ahead of the Curve podcast. And today, Micah and I have uh, some pretty amazing information to share with you. It's something that trips a lot of people up when it comes to the type of corporation that they use to set up their business. So, in today's video, Micah is going to walk us through the S-Corp compared with the C-Corp and when you should use one versus the other. I know with the years that I've been in business and done business acquisitions and things like that, there's a lot of people that talk about and promote the C Corp, and they claim that it has favorable tax status. And as Micah is going to share, there's really only certain instances that makes sense and why. So Micah is going to break this down into 7 parts for us. We're going to go through them as quickly as possible, but this is pretty deep information, and this is really important. So we want to make sure that we take the time to dive into this and really let him share with us from a tax perspective when an S corp and a C corp is best and how they compare with one another. So, Micah, I'm going to let you take the reins on this because this is your territory.
Yeah, and again, we'll try to go through this as quickly as possible. The general sort of TLDR on this is that C corps largely only really make sense if you're trying to raise capital. It's easier to raise capital. You don't have the restrictions on shareholders. You can have different types of stock. S corps have a lot more limitations on that. The only other instance it could make sense would be if you are in a really high income tax bracket already and you've got no desire to distribute your profits to yourself for a really long time. But as we'll kind of see as we're going through this, unless you fall into one of those two categories, it's really, really hard for it to make sense. And that's kind of a lot of this video is a counterpoint to the internet gurus out there who will so heavily and aggressively pitch the C Corp and how amazing it is.
You know, what you were saying about there are certain instances where it makes sense. In some of our previous videos, we talked about how you need to plan ahead. Like most people that decide to set up a company that becomes publicly traded, typically like that doesn't happen by accident. They had a
Right.
vision for that going into the fact that, hey, our desire within the next 5 or 10 years is to take this company public. It doesn't just happen by accident. So the point here is that, one, when you're setting up your corporation, or if you're early on in your organization, you can have an idea to say this is when the S corp may make sense. We do want to go public. We do want to raise capital, and so it may make sense. Let's talk to a CPA and find out. But like you were saying, there's a lot of gurus and people out there promoting the C corp, which is really old news, as some secret trick, and we're just going to see
Right.
today what it really is.
Yeah. So where those gurus will start is that the top individual tax rate is 37%, but C Corps, their tax rate is only 21%. So they say, look at that 16% savings. Look at that amazing arbitrage. Why wouldn't you want to do that? And again, I'm not saying there's never a case where it could make sense, but it misses several different pretty key points, and it's a way oversimplification. So we'll go through the bullet points real quick, and then we'll actually dig into each one. The first one is that 37% is the top individual tax rate. That's not your average or your effective tax rate. The second
Okay.
is we need to look at what the average American household is. Third is that C Corps aren't eligible for QBI, qualified business income deduction. Fourth is that C Corps are also not eligible for the pass-through entity tax election, which we discussed in a previous video. Fifth is that if you do distribute the profits to yourself in a C Corp, those dividends, those distributions are taxable in addition to that 21% tax when the money was earned.
That's a
The
big one.
sixth is that big one. The sixth is that C Corp tax rates are likely going to go up because they're lower than they've ever been. And seventh is that you're not paying into Social Security and Medicare unless you're paying yourself a salary from your C Corp. So
Perfect.
that's rattling off real quick. So starting with the first one is that again, this rate arbitrage sounds a lot better on paper than it does in practice because you say, okay, 21 is less than 37. So isn't that great? We're saving so much money. But it ignores a pretty basic fact that 37% that's what the top income tax bracket is. So one, you've got to be making enough money to even get to that bracket, and also it's only the money after those last dollars that are being taxed at that rate. Versus on the C Corp, that's a flat 21% from the first dollar of profit you earn. If you look at the 2023 tax brackets, you can see that the vast majority of your income isn't taxed that highly. We start at 10%, then go 12%, then 22, 24%. If you're married filing jointly, all of your income up to about $190,000 is taxed at a maximum of 22%.
Well, and I think that's the part that I want to make sure that we don't breeze over, is that it's not the entire amount of your money that's being taxed at 37%. It's the amount of money that's in that part of the bracket, of the tax bracket.
Right.
This is not a, if I make $1 million in a year, I pay 370,000 in taxes. It's only the amount that's passed, or what puts you into that top tier tax bracket. So the average tax rate is much lower.
Right, exactly. So for you to get up to that 37% tax bracket, you've got to be, if you're married, you need to be making $363,000 a year. If you're single, you need to be making $578,000. So the majority of your income, if you even reach that amount, is being taxed at a much lower rate. So one of the things that we did, and this is a really quick and dirty calculation, but we just plugged in, all right, let's say that you made $100,000 to your total income, not counting deductions or anything else, but just saying that your total income was $100,000, $200,000, $300,000. Well, for you to, at $100,000 of income, if you're single, your effective tax rate, that sort of blended tax rate, is only 15%. If you're married, it's 9%. At $300,000, your effective tax rate is 25% if you're single, and about 18% if you're married. And again, that's a rough calculation. It doesn't have dependents in it. It doesn't have qualified business income deduction. But just to give you a rough idea, the sort of break even on when you're going to be earning close to that, being charged close to that 21%, is in the hundreds of thousands of dollars.
Right.
And that kind of brings us to the second point, is that these gurus and self-help guys who are pitching this so aggressively will be like, well, if you have any amount of success, of course you'll be paying a higher tax rate than that. I mean, we're giving you this amazing advice, and you're amazing business people, so you're all going to be making seven figures within the next year. And
Sounds nice.
aspiration aspirationally, that's very nice, but it just goes against just the reality of what most people are making. And the most recent numbers I could find were from Census Bureau's around 2021, but the average household income in America was somewhere around $70,000. So if we go back to the numbers that I just gave, and you're making $100,000, well, if you're single, your effective tax rate's around 15%. If you're married, it was 9% in the scenarios I ran. That's way less than 21%. So if you're earning what the average American household is earning, then again, that rate arbitrage not only is not nearly as favorable as 37 versus 21%, you're actually paying a higher income tax bracket on the earnings with the C Corp. That doesn't even get into what we'll discuss later about the distributions also being taxed on top of that.
Well, and I find a really good way to keep yourself back from earning seven figures is to consistently pay more in taxes than what you're required to.
Right, exactly. I mean, so long
So,
as you just keep funneling that to the government, then
you know,
it's just
it's like, I
you're
know
you're
I'm not
man you're man
required to,
you're
but
you're
I want to.
manifesting your success by paying more and paying as much in tax as you want to be earning based on the income you want to be earning later.
Right. What do they
That's
say?
hilarious.
Dress for the job you want.
Right.
So this is pay taxes for the income you want.
Right.
So,
Um,
but
right, it's
but I
just
well I think that, to be fair, and I wanted to mention this a little bit earlier, is when it comes to the S corp versus the C corp, the the C corp, as you mentioned, it does have a place. And what's really
absolutely.
important is that you have the people around you that can tell you when you're approaching that place or when you have entered that place. Really, because
Yeah,
really, you can get there. You can get there. You absolutely
sure.
can get there. We both, have seen it over and over with our clients and our partners and our companies, right? We've seen this. But here's the thing, is the statistics, you're talking about average household income. The statistics are that really only 1% of people get there, right?
Right,
And so,
if we go to $300,000 would put you in the top 5% of earners, and I think basically any state in the union.
yeah,
And that's not and at 300,000, the C Corp wasn't even a slam dunk, but you would be beating
right.
95% of people if you made it that far.
Yep. Yep. And beyond that, a very small percentage. And again, you can get there, but you anybody who gets there is making these changes and these shifts and these adjustments as they go down that path, right? You go as far as you can see, and you'll see a little bit further, right? And that's why,
Mhm.
again, the important thing is that you have the people around you who, as you're approaching that, say, "Hey, your business is growing pretty rapidly. We're looking at these numbers, and this is probably something you're going to want to think about here in the near future." You know
Yeah,
that you'd be
absolutely.
able to calculate that, so you're not caught off guard. But the key is not to say, "Oh, well, this business guru told me that I should do this now," when that's not the circumstances now. You just need to make the change or do it before the end of the tax year.
Right, and there's certain things, it all depends on the trajectory and what you think you're looking at. If we have clients who have been earning 7 figures with their main business and are gonna start something new, and we've got a track record of what they're gonna do, they've got investors lined up, there can be instances where the C Corp makes sense for various different reasons. The difficulty I'll have is so often the gurus will be talking to people who have never operated a business successfully in their lives, and then they're telling them, well, obviously you're going to make $500,000 your first year, so obviously then the C Corp makes the most sense.
Obviously,
There could be instances where it does make sense, but it is absolutely the exception rather than the rule. I think it's the
yeah,
thing that I think both of us want to highlight in this discussion.
yeah, definitely. No, that it makes a lot of sense, and I think that's a really good point. Not that we want to stifle anybody's ambitions. We just want to say, hey, if you're not there, don't make the change there right now.
Right.
Um, when you are approaching, you'll know. you'll
Hmm.
you'll
Right.
get that
It's
call
going to be
from your accountant. Hey, you're doing pretty well
well.
this year.
Yeah, it's going to become apparent to you pretty quickly, and then you can either restructure, start a new, and there's different things you can do as that start. Your business will start telegraphing to you where it's going,
Yeah,
and if that's the situation you're going to run into.
and this might be helpful. I don't know if you've noticed this, or um when you go into, like, if you don't hear it from, like, if you're not meeting with your CPA or accountant throughout the year, some other indications of it, that you'll notice, is you start getting information, like when you go into your bank, they start pulling you aside and asking you about investing, right?
Right.
Or you
All of a
go into
sudden,
the
you've got
bank.
so much cash sitting around.
Yeah, yeah. You go in just simply for a deposit, and they pull you aside, and they're like, "Hey, can we talk to you about a couple things, on your account?" That's how you know, like, your business is doing more than average. Or if they start just offering you loans that are unsolicited, or lines of credit, right? Those are
Right.
just indications of, hey, the business is doing better than average. So we're
Yeah.
talking about average US income, average household income. One indication I've noticed is that when the business is really cooking, you start getting the bankers pulling you aside when you go in to make deposits, right? That's one thing. The other thing is you'll start getting, direct mail talking to you about accredited investing opportunities, investment opportunities, period. All these to me are just little indications that, hey, I'm doing better than average. Somebody should, I should probably talk to my CPA to see where, like, how much better than average, and if some
Oh,
changes need
sure.
to happen.
When we're meeting with clients, a big part of the way our practice has shifted from when we first started and would deal with any business versus now dealing with higher income earners is that a much bigger portion of our discussions aren't, well, how are you going to pay this tax bill or how can we squeeze out this little extra bit? It's, how do you want to deploy all this capital that you're building up?
Yep.
We need to spend this money somehow. What's going to be a good use of it for you? There's going to be typically, unless you're just debt laden or something unusual, there's going to be an excess of cash that starts to be an indication.
Yep. Absolutely. All right. Well,
So
I'll let us move into the next point then.
no, yeah, these two will go pretty quickly because we've discussed them in different videos, either completely dedicated to it or just partially. But the third point is that C corps are not eligible for the qualified business income deduction, or what they call QBI. So we've talked about this before, but QBI allows a pass through or flow through entity to take an up to 20% sort of bonus deduction off of whatever their profit is. So if you make $500,000 profit in your company, you're eligible for an up to $100,000 on that $500,000 profit, $100,000 deduction just for existing and just for it being there, which can be huge. C
Yeah,
corps not being
and that specifically is on anything that's passed through, like the S corp.
pass through entities like S corps, partnerships, sole proprietorships, they qualify for that. So
Okay.
C corps are not pass through entities, so they're not eligible for QBI, and that 20% deduction on its own can be pretty massive. And again, going to the numbers that we talked about previously, that's just the general rate arbitrage. That doesn't even factor in this QBI and how on the S corp your taxable profit could be up to 20% lower effectively.
Yep.
So,
Yep.
similar vein to that, the fourth point was that C corps are not eligible for the pass-through entity tax election, and we did a whole video on that a while back. So I won't get too deep into that, but the basic crux of that is that it allows you to pay your state income tax on whatever your business's profits are at the entity level. And by doing that, it allows it to be a business expense.
Right.
Again, that's for pass through entities. C corps are not pass through entities, so they're not eligible for that.
Yeah, and these are,
Um,
and even though we've already covered them, I'll put the links below in the description. But the those are two really big ones, really big
yeah, those
potential
are.
savings on that.
I'm sort of glossing over them just because we've had in-depth discussions on them
Yeah.
previously, but the tax savings on those can be absolutely tremendous. So, uh, in the scheme of this video, I'm glossing over them, but in the grand scheme of things, they shouldn't just be discounted too much.
Yeah, we'll put those
So,
in here.
yeah. So the fifth one is pretty massive, and again, is not what the gurus will talk about. But distributions from your S corp are not taxable. That income is taxed when it's earned. So whenever you pay those distributions, you paying those dividends doesn't trigger a separate taxable event. That's not the case with C corps. C corps, you get hit with double taxation, where you pay tax, you pay that 21% when the money is earned, but then whenever you distribute the money to yourself, you're paying tax on top of that. That triggers a totally separate taxable event. And assuming you've owned the C corp for more than a year and you're getting what they call qualified dividend taxation, the tax rate on that is somewhere between 0 to 20%. For most people, it would be about 15%. So you're
Okay.
paying the 21% right here. And then whenever you pay it out, you're paying probably 15 to 20% on top of that. So the effective tax rate could go to 41%, not counting the fact that you didn't get the qualified business income deduction, not counting the fact that you didn't get the pass-through entity tax election. So people will start just with that surface level again. Said at the outset, 21 is less than 37, therefore go with 21, but it's just a way oversimplification.
Yeah, there's too many factors to oversimplify it that much. And so as you're going through this, I'm thinking, so if you've got a C Corp, right, you got the 21% of all income earned that's being taxed, right? You you have the if you're taking dividends or distributions, right, those are being taxed basically as capital gains depending on how long you've owned the
Right.
corporation. But then wouldn't, if you were taking a salary from that company, wouldn't you also be paying additional tax on top of that?
Right, and I mean, that's one of the I think we had it listed as number 7, but we can touch it now, is that
Oh, we can.
and
You're right. I'm sorry. I had forgotten
no,
about that.
no, it's fine. No,
So
it's easy enough. I mean, there's no real a few of these had an order. These were
we
sort of
do
these
not.
last ones are these were the bonus ones. But with an S corp, you're required to pay yourself a reasonable salary via the W-2. And that's people don't like doing that just because you're paying Social Security and Medicare then, but one of the benefits is that you're at least paying into Social Security for when you retire. But with the C Corp, there may be instances where you need to pay yourself a W 2 and pay yourself a salary. But in the case that you're doing that, it's definitely not a tax advantaged way to do it because you're paying the 21% on the corporate side, then you're paying ordinary income tax rates on the W 2. So you're not getting long term capital gains or qualified dividends treatment at that 0 to 20%. You're paying just your ordinary income tax rates. And then you're paying Social Security and Medicare on top of it, which is another 15.3%, assuming you haven't capped out your Social Security already. So while you can pay yourself via W 2, it's just it's not a particularly tax advantaged way to do it. Admittedly, paying yourself the W 2 does reduce the income tax on the C Corp itself because it's reducing the C Corp's profit, but it's still not great that you're paying the ordinary income tax rates plus payroll taxes on this side.
Sure.
So it's another one of the reasons why the math just doesn't math so well once you factor in any sort of movement from the business to your personal name, be that via um, actual payroll or distributions.
That's my new favorite saying, by the way. The math doesn't math
Just
so well. That will be a, yeah, if you're watching this, you will see that tweet come out
yeah.
soon, multiple times. The math doesn't math so well. So
Well,
no,
and again,
and
you just run through it, and again, not there's never a catch-all like solution for any situation. There's a bunch of different things you have to consider, but that's what will be so maddening when you get the and you see this in marketing, you see it with operations, you see it with any aspect of business where people will try to distill something reasonably complex down into a 10-second soundbite or a single bullet point or a headline or something. It's just n- not the way it works. And also, if it was that amazing and that universal and just that perfect for everyone, it wouldn't be this sort of hack the way they're presenting it. It wouldn't be the fact that th- the way that people are doing it right now, where it's an unusual strategy. There's sort of a reason it's an unusual strategy, and that's because it's usually not nearly as effective as they want to make it out to be.
well, and that's the thing is you'll get this advice, you'll go to a conference, you'll hear it in a course or a YouTube video, and really with
Hmm.
this, like I think you hit the nail on the head because we don't want to give generalized advice in this. This is not the it's not the purpose. The purpose of these episodes is to help you to see how does this really work? Like and not to be dogmatic and be like, "Oh, you should always have a C corp or an S corp and you should never have a C corp." Again, we've said from the beginning of this video that's not the case, right? There are certain strategies. We both deal with these strategies where somebody comes to us and they say, "Hey, I am thinking about taking this company public in the next 5 to 10 years, right? Okay, let's look at what that would look like." And there are high income earners with the way that they have their corporation set up that it does make sense in some
Hmm.
instances. But again, those are the exception. And we would, I mean, I think I can speak for you as well. Like we would desire that everybody get to that point. right?
Sure.
But the
Absolutely.
facts, the fact of the matter is that the C Corp's been around, for a long time, but the S Corp was created to stimulate business growth, to make it so that people could get into business and they could have the benefits and the protection of the corporation. Because I guess, it's more appropriate to say that it's an election, right? A tax election. It was created to stimulate economic growth, right? To make it so that it was easier for people to start companies and have the protection and not be held back by taxes, corporate meetings, and just complexity that
Well,
they weren't trained for, they weren't equipped for.
Well, and it just makes it easier for people where it's closely held companies. It's a more S corps are typically more tax advantaged. It gives the owners easier access to the money that's being earned without having a separate taxable event. There's reasons for it, and that's why the majority of businesses that are making decent profit, the not the vast majority, but the majority, an S corp makes sense, and what we see probably more than anything else. But yeah, there's absolutely points where the C corp makes sense. I think that sort of dovetails into the last bullet point we had on this, is that C corp tax rates are likely going up. And I think the reason this became popular with the sort of guru class is that up until 2018, the top tax rate for corporations was 35%. So when you're talking about 35% for a corporation or individual being, I think at that point it was like 39%. Well, once you factor in it's 35% on the C corp side, then you're paying tax on the distributions. Well, that's horrible. There's no way for that to be something that people would advise as a tax saving strategy. You would do it because you need to raise capital or something else. But then when the tax rate got dropped down to 21%, then on its the surface at least it starts to become more attractive, and it's at least a discussion now. But
Right.
tax rates are probably going up. We haven't seen it get any traction yet, but these tax rates are either the lowest they've been or the closest to lowest that
They're
they've ever been.
historically
They're
low. Yeah.
they're historically low. So what we've been seeing, the number we see most often is that getting raised back up to like 28%. Well, the math isn't great right now at 21%. If it raises much at all, then it kind of, in a lot of situations, will blow up the tax savings component of this. So that's another thing people should take into consideration, is that it's possible to likely that at some point in a year or 5 or whatever, that tax rate is going to go back up, because a return to 28% is still lower than it's been historically. It's not like we're talking about it going back up to 90% or something. That's still a pretty low amount, and there's been whispers of raising that pretty much since they cut the rate down.
Well, yeah, and that's the thing, is just on the we tend to see in life in general, right? Things just regress to a mean, right? Things snap back to an
Mhm.
average, right? And like you said, we are, at least on the personal side, we have historically low tax rates. Like that's just the facts. We are in a lower tax rate than we've seen in history. Um, really for the past 100 years, there have been times where it's been lower on the personal side, but not many, not
Right.
many.
Yeah, and
And
that's why I was hedging. I
and
was trying to remember if there had been
yeah,
weird outliers, but on average, absolutely.
Yeah, really, it is. And so, what we see right now is we're below the average, both on the corporate tax rates and on the personal tax rates. And so, when we see that, and we see, we've seen it, depending on when you're watching this, the news is going to change, obviously. But over the past couple of weeks, we've seen talks about, the debt ceiling. We're, as last time I looked, like 27% over the national debt ceiling, and what's owed due to the COVID-19 pandemic and all that. And the fact of the matter is that national debt has to be paid back with income tax. And so there's, they have amounts that you look at to say, this income tax and this corporate taxes that's going to pay back that national debt. That's why they talk about raising tax rates, is because they have to pay down that debt or they have to restructure the debt. And it's pretty extreme to restructure. It's
Right.
simplest. It's actually the strategically the in my opinion, the most strategic move is you've got the majority of the baby boomer generation that is going to be retiring or hitting retirement age in the next 10 years. That generation holds most of the money in tax deferred type of retirement accounts like IRAs, number one, and 401ks, number two. And so the most strategic move by the government is to say, let's increase tax rates as this wealthier generation moves into retirement in legally tax deferred accounts. Right? That's the most likely, or the where most of the money sits, in my opinion. So the odds of tax rates increasing both at a personal level and a corporate level there's some good argument to be made for that. And again, if that's the case, then you personally, for your situation, knowing what you know about where you're going in your business, need to connect with somebody and assess, where are things at? Here's my situation. What's best for me? We want to educate people with these videos of what's going on right now, but the only thing that's certain is change. And so,
Right.
you need to know personally, like, we want you to know these are the factors so you can go in and have an educated discussion and come out with the best outcome based on what you now know. But it has to, the key is, like, it has to be applied to your personal situation.
Yeah, absolutely. And
I'm
for
off my
this
soapbox now.
video, and no, every one of these videos we do, we're talking about things in general terms and an overview of the situation, but they're, they everyone's situation is different in their lives in general, and that goes through to their business and finances. And what we would tell people on a 10,000-foot view, once you actually dig into all the details, could be very different. So, again, most of this video is sort of a rebuttal to the guys who try and pitch this as the C Corp as the end all and perfect for everyone. But I guess sort of to, for my portion at least, to cap this off, is when can C Corps actually make sense? There's basically two scenarios that I can think of where it would make sense. One is that if you're trying to raise a bunch of capital, and you can raise capital within LLCs or other structures, but especially if you're getting VC money, a lot of times they want it to be a C corp because they want the track record on. It's easier with the track record on the return. You can have different classes of stock because most VCs will want some kind of preference either on
Yeah,
the
a
first
preferred,
payout, or
yeah,
if it, or
preferred or voting rights or things like that.
yeah, there's something to where they want a preference with their class of stock. So that can make sense if you're looking for outside money, and a lot of outside money especially. But if you're talking about just your general operating business, the only other time that can make sense is if you're already a super high earner and you have no intention of distributing the profits to yourself for a really long time, because then you're not getting hit with that double taxation either ever, because you never distribute the profits and you continue reinvesting in the business and growing business profits that way. I'd hedge there because you can get into personal holding. There's some specific rules with C corps you got to make sure not to run afoul of. But if you're doing that and you say, okay, I'm already on the top tax rate on the individual side, so I'm saving 16% here, and I'm not distributing this money for 20 years, well, then that rate arbitrage and sort of a time value of money calculation, you can say, okay, I'm saving that 16%, which is allowing me to reinvest in the company. There can be instances where it makes sense, but it really does, in my opinion at least, come down to you already got to be in a really high income tax bracket, and that C corp money you are not looking to distribute to yourself for a long, long time.
Well, and what that made me think of is, like, the scenario that you just described is we're building the next Amazon.
Hmm.
Right? Where you're not taking profits for 20 years, high income earner. right? Uh, Startup capital with VCs that want, preferred stocks with voting rights, and so that they can control, and all these different things, right? And so again, it's a rare instance, I think, where it makes sense,
Yeah, absolutely.
um,
And if
and
you're going to your core business, your bread and butter, where you are getting your livelihood from, it would be exceptionally rare for it to make sense.
yeah, and one clarification on that too. What we're not saying is, we're not saying that you never intend to sell the company, right? You may hold the company and grow the company for 20, 25 years, and then have the intention of selling it, and taking your profit from the sale, or earning out, or whatever you decide to do. You can still do that with any type of corporation. Right.
Yeah,
So this is not saying, oh, if you ever intend to sell it. No, we're talking raising capital, potentially going public, not ever taking those profits out so that you can reinvest. So those are two very different things. Again, we've talked about it in other videos, but you from the beginning likely have the idea in your mind of what this company is going to become in the next 5 to 10 years. And that should guide your decision about what type of corporation you use, and what your personal financial situation is, and what you need to live off of. And all these factors come into play, but generally, the S Corp is a better setup for most people, which is why we see most people in it.
right. Exactly.
Well, this is such great information, and I really hope that this just clarifies this, for so many more people that have had questions. People who have attended one of those events, have talked to one of the gurus, have watched one of their videos, right? And they're like, "Oh man, this is so confusing." Hopefully this cleared a lot of that up, and provided some solid statistical information, some information to help you see how this works. And as always, we're going to put a lot of links in the description here today, just because there's a lot that was covered here. But if you have any questions, I will have a link to the calendar so you can connect with us and ask some questions personally, for your circumstances, and get some of those answers. And we can show you what would be the best fit based on those circumstances. So, check out some of the links below, book a consultation with us if you have any questions. And hopefully this is helpful. If it was, put some comments below. We'd love to hear your thoughts or your questions. And if not, then we'll see you in next week's video.